The situation is bad. If only you knew how bad it really was. I don't know how bad it actually is. I'm not a politician. I'm not in the White House. I'm not on Wall Street, but I'm a Bitcoiner. And I can pull up a chart, look at Bitcoin's price action, and know how bad it really is.
The market feels unrecognizable right now. This was supposed to be the window, the phase in the cycle where momentum builds, confidence returns, and excess finally breaks to the upside. Instead, what we're watching looks nothing like a healthy consolidation. Bitcoin has lost over $53,000 in just 4 months, collapsing from a peak near $126,000 to fresh yearly lows around $73,000. More than $1.1 trillion in market value has been erased. And the most unsettling part? This isn't happening in isolation. U.S. equities are barely off their highs. Volatility is muted, and yet crypto is acting like something has already snapped. That divergence is impossible to ignore. The S&P 500 is down barely 1.5% from its all-time high. The Nasdaq is just a few points more. Meanwhile, Bitcoin is down 42%, Ethereum is down 56%, and the broader crypto market is trapped in what feels like a relentless drawdown. Historically, this kind of disconnect only shows up when markets are repricing risk itself. When capital quietly decides that something is no longer safe, no longer liquid, or no longer trustworthy. That raises an uncomfortable question. Is this simply aggressive suppression, or is there a structural problem inside crypto that hasn't fully surfaced yet? Because on paper, the news flow should have helped. Just this week, President Trump signed legislation officially ending the U.S. government shutdown. In past cycles, prolonged shutdowns drained liquidity, delayed risk appetite, and weighed heavily on speculative assets. The last major shutdown dragged on for 43 days and left scars across markets. This time, the fear was clear. Another shutdown could choke off sentiment, just as crypto was already vulnerable. So when that risk was removed, prices should have breathed. Instead, they fell harder. In fact, the opposite happened almost immediately. Bitcoin dumped nearly $1,700 right after the U.S. market open, wiping out over $55 million in long positions in just 2 hours. The broader crypto market lost $50 billion in the same move, despite objectively positive macro news. This pattern has become disturbingly familiar. Good news triggers sell-offs, relief rallies get sold into, and every bounce feels engineered to lure liquidity before another leg down. At the same time, on-chain data shows large holders quietly accumulating. Coins are being absorbed, just not reflected in price. That contradiction is fueling growing concern that price discovery itself is being distorted. And then came what should have been a turning point, a rare, high-level sit-down at the White House between crypto leaders and the traditional banking establishment to really show how much the Trump administration cares about crypto.
Crypto person, I'm the one that probably helped crypto more than anybody because I believe in it. And the reason I believe in it is because if we don't do it, Scott, I think we can say then China's going to do it, right?
Yes, sir.
If we don't do crypto, then China's going to do it. And
the stated goal of the meeting was clear: address stablecoin yield, regulatory clarity, and the growing tension between innovation and incumbency. The room itself told a story. Major banks, trade associations, fintech giants, crypto exchanges, stablecoin issuers, venture firms, and even payment processors. On the surface, it looked like progress. Serious people, serious institutions, finally in the same room. But beneath the optics, the divide was stark. Sources described a clear imbalance. One side trying to build forward, the other trying to slow everything down without saying it outright. The meeting was described as constructive, even cordial, but it ended without resolution. No breakthrough, no alignment, just boundaries drawn more clearly than before. Here is Coinbase's Paul Grewal on the outcome of the meeting and the way forward for the Clarity Act.
And of course, Coinbase was a major participant in the meeting yesterday at the White House. What was the main takeaways from your standpoint?
Well, I think the main takeaway for the American people to understand is that the White House is fully engaged. Full credit to President Trump for prioritizing this conversation about the right way to regulate crypto and bring innovation to our financial system. I think it's also very important to understand why the American people should care about this at all. This is fundamentally about not only innovation, but competitiveness in our financial system and making sure sure that the U.S. dollar remains the global reserve currency and isn't replaced by a Chinese central bank digital currency. It would be a disaster for America if that were to happen.
No doubt about it. How will the dollar get undermined by this?
Well, what the dollar fundamentally needs ultimately is demand. As government debt rises, interest rates are critical. What stablecoins, a particularly important part of crypto, do is drive demand for U.S. dollars in ways that keep U.S. debt in check and keep borrowing costs low. And fundamentally, they also preserve the dollar's role as the currency of choice in global trade. So we think it's important that there be rules around that. Well, what I think bank lobbyists have done in confusing the American people and leaders on both sides of the political aisle on this issue, first and foremost, has been about is preserving their incumbency and limiting competition. The fact of the matter is there's no evidence whatsoever that stable coins or crypto more generally draw interest or demand for community bank deposits and other deposits away. In fact, they support the traditional financial system by, again, supporting the strength of the U.S. dollar. It's not surprising that the bank lobbyists want to preserve that incumbent position because, of course, the bank lobbyists represent interests that have over $3 trillion, Maria, parked at the Federal Reserve that isn't doing anything, that's simply just sitting there when it could be put to work for the American people. We think it's important that that capital be deployed much more than have false concerns about competition.
Well, what do you want to say to the critics who say, look, the crypto companies want it both ways. You want to be able to pay rewards and get a flight to capital into the crypto platforms, but you're not going to face the same regulations that the banks face. In other words, are you going to have deposit insurance?
Well, it's a very strange argument to make that somehow the crypto industry is seeking to avoid regulation and oversight when it's pushing for this legislation to be passed, and it's the bank lobbyists that seem to be digging in. No, we think sensible rules for crypto make good sense. We also think it's very important that consumers understand what they're getting when they make deposits to a stable coin or otherwise engage with the crypto economy. We're all about transparency and competition, and we want regulation and rules that encourage that.
That stalemate matters more than it seems, because stablecoins aren't just a crypto issue. They sit at the intersection of U.S. debt, dollar demand, and global financial power. They represent trillions in potential capital flow, and that's exactly what makes them threatening to legacy institutions. When discussions stall at this level, it sends a message to markets. The political will may exist, but the system itself is resisting. And markets, as always, feel that resistance before the headlines do. So here we are, prices collapsing, optimism punished, good news ignored, and policy progress moving at a glacial pace. Investors are left staring at charts that refuse to heal, while the most important conversations in the background fail to produce clarity. Whether this is manipulation, structural stress, or a deliberate pressure campaign is still unclear. But one thing is becoming obvious. This isn't just another dip in a bull market. Something bigger is unfolding, and the next phase will force everyone to choose whether they truly understand the system they're invested in. Before we go any further, I want to hear from you. After everything you've just seen, the divergence, the failed rallies, the ignored good news, do you think this is manipulation? Or do you think the system itself is under real stress? Drop your honest take in the comments. Reading how others are interpreting this moment helps all of us see the full picture. And if this kind of deep analysis matters to you, do me a favor and make sure you're subscribed so you don't miss what comes next. Back to the video. What makes this moment especially unsettling is that the market isn't just reacting, it's communicating. Price action is no longer behaving like noise. It feels deliberate, almost diagnostic, as if something underneath the surface is under strain. That's why voices who understand macro plumbing, liquidity cycles, and monetary history matter right now. Not because they can predict the exact bottom, but because they can explain why stress shows up where it does first. The argument here isn't about short-term price targets or hopium. It's about what Bitcoin is signaling when liquidity tightens, when debt loads collide with political reality, and when policymakers are forced into choices they've been delaying for years. Earlier, you heard the claim that the situation is far worse than most people realize. What follows is the reasoning behind that statement, not as fear-mongering, but as pattern recognition grounded in history.
Bitcoin is a truth machine, guys. It's telling us the truth. It's telling us the deep embedded stress that's in the global financial system right now. It's the only free market we have left that can talk to us and tell us something. By the way, gold is telling us something too, just the opposite direction, and eventually they'll invert I know, it's frustrating. It's okay. Lower your time preference. They'll invert. Ray Dalio warns that the monetary order is breaking down, leaving us with a terrible choice. Do you print money or let a debt crisis happen? The debt crisis is upon us. We can see it in the bond market. We can see the JGB yields go up and the currency, JPY, go down. We can see US attack inflation, solve for inflation, but the 10-year is still high. And the 10-year being high is what causes things like the housing market to be unaffordable. Mortgage rates are too high because the 10-year is too high. These are structural issues that scream we are on the brinks of crisis, of a debt crisis, unless we print the money. And the reason Bitcoin sells off, again, it's telling you something. The crisis is upon us. The situation is bad. If only you knew how bad it really was. I don't know how bad it actually is. I'm not a politician. I'm not in the White House. I'm not on Wall Street, but I'm a Bitcoiner. And I can pull up a chart, look at Bitcoin's price action, and know how bad it really is. And so here's my message to you guys, and to make sense of all this, where we are, okay? What you're looking at is silver, Bitcoin, and gold during the COVID era. You see this red mark here where it says Bitcoin is dead and gold and silver were kicking Bitcoin's ass? Okay, guys, for those that weren't around, when COVID hit and it was extremely deflationary, it was like, this is going to be a Great Depression, extreme austerity, we're going to have a debt crisis, everything's going to fail. Bitcoin collapsed all the way to $3,000. Okay, it collapsed 50, not 15, 50% in one day. You guys think this is bad? Imagine the thing going down by half, cutting in half in one day. That's what happened March 2020. Dead ass serious. Okay? And then as Bitcoiners, we watched gold and silver run and outperform Bitcoin in the coming months. And the reason I'm not panicked, I'm not worried, I tell you guys, like, guys, just stay focused. Like, this is how these markets work. It's because I've lived through this already. This is the exact same thing that I have already lived through this. Gold and silver kicked Bitcoin's ass when liquidity got tight. They front ran the liquidity, okay? And then the printing came, because again, you either collapse the world or you print the money. And when the printing came, Bitcoin whipped everyone's ass. It went from $3,000 a coin to $70,000 a coin. That's over a 20x. Over a 20x. Okay? So it depends on where you're counting. Let's say you're taking, the bottom of this last cycle was around $20,000 and you want to 20x that. That would put us at 400K, 400 to 500K, right? You want to 20x from where we are now. That'll put you at $1 million a coin. I don't know. I don't know where the top's going to be. I can't predict the future. All I can tell you guys is how markets work and how we can use the past to understand where we are now.
What stands out most isn't the comparison to past crashes, it's the sequence. When stress enters the system, markets don't respond evenly. Capital doesn't rush straight into risk. It hides first. It seeks what feels immediately stable. That's why assets like gold and silver can outperform in early stress phases, even as Bitcoin sells off. Not because Bitcoin is broken, but because it's still treated as liquidity sensitive before it's treated as monetary insurance. This also reframes the current drawdown in a way most investors miss. The sell-off isn't evidence that the thesis failed. It's evidence that the system is tightening faster than expected. Bond yields staying elevated, housing affordability breaking down, currencies weakening while rates remain high. These aren't isolated data points. They're symptoms of a debt structure that can't normalize without something giving. When markets are forced to choose between deflationary collapse and monetary expansion, history shows they never choose collapse for long, and that brings us to a very different, but equally important, perspective.
Is this worse than you expected, or pretty much what you were thinking?
Well, and parts of it have been much worse. Like, how I think the crypto market has taken it much worse than we expected.
Why?
I think part of it is the crypto industry doesn't have any leverage right now. It sort of delevered in October. And now when we have gold and silver doing so well, especially at the start of the year, that created FOMO, and that was like a vortex sucking all risk appetite towards the precious metals trade. So I think crypto has suffered from that on a price basis at a time when the fundamentals have been good. You know, it's been a contrast. I think the broader economy is actually in good shape. So to me, the turmoil here is kind of what you said. There's a lot of uncertainty because of Washington picking winners and losers, and some of this could be the new Fed pick. But I'm also kind of heartened. I think gold and silver taking a breather is actually a good thing. I'm going to say something that it sounds a little contrarian, but okay. Tom DeMark is our advisor at BitMine in terms of crypto. He's been since mid-November saying Bitcoin would go to 77 and Ethereum at 2,400. So he's been waiting for what he calls time and price to align. This weekend, he believes we reached that alignment. So all the pieces are in place for crypto to be bottoming right now because we're getting the level and enough time has passed. So I think as long as crypto fundamentals are good, which is the case, you know, Ethereum active addresses is going parabolic right now, and activity. Part of it is, of course, Wall Street is building up digital assets and converging those businesses. If that's the case, then crypto prices should follow.
Tom Lee isn't arguing that a new bull run starts tomorrow. That's the key distinction. His outlook isn't about explosive upside. It's about stabilization, about markets exhausting sellers, about downside momentum slowing as macro pressures become better understood and partially priced in. In other words, not euphoria, but relief. And historically, relief phases are where smart money positions, not where headlines celebrate. Taken together, these views don't contradict each other. They complete the picture. One explains why the pain exists. The other explains why it may not need to deepen indefinitely. Crypto doesn't need perfect conditions to bottom. It needs uncertainty to peak. It needs forced sellers to finish. And it needs capital to quietly move from weak hands to strong ones. Something on-chain data increasingly suggests is already happening. So while price action still looks ugly, the foundations underneath the market haven't collapsed. Development continues. Regulation is being argued at the highest levels. Liquidity hasn't disappeared. It's repositioning. And if there's one lesson markets repeat relentlessly, it's this. Price usually moves after the narrative feels unbearable, not when it feels comfortable. We may not be at the start of a new rally yet, but moments like this, where fear dominates, headlines disappoint, and accumulation accelerates in silence, are rarely meaningless. Whatever comes next won't reward impatience, but it will reward those who understand where stress turns into opportunity, and who know how to follow the money when no one else wants to look. If you've made it this far, you're not here for hype. You're here because you're trying to understand where we actually are in this cycle. These are the moments that define outcomes long before prices reflect them. If you want to keep navigating this with perspective, patience, and a long-term lens, like this video, subscribe, turn on notifications, and check out our other videos featuring insightful analysis from top experts. Thanks for tuning in, and see you in the next one.